Hello everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're putting a spotlight on a company that's been making waves on our screeners, BOXL Corporation, ticker symbol BOXL. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's kick things off with a quick look at BOXL. BOXL Corporation operates in the technology and consumer electronics sector, designing, producing, and distributing interactive technology solutions. Think interactive flat panel displays for education, health, corporate, military, and government sectors globally. It's a microcap stock currently sitting with a market capitalization of $4.06 million. Joe BOXL logo and company description on screen. Looking at its recent price action, BOXL has seen some significant movement. Today it's up plus 2.21%, but over the last 5 days it surged an impressive plus 134.1%. Even looking at the last 30 days, it's still up plus 37.62%. Volume has also picked up, with today's volume of 4,059,500 shares, which is 1.5 times its 30-day average volume of 2,799,571 shares. Show chart with price and volume highlighted. What is cost to borrow and why it matters. So, why are we talking about BOXL? Because it's flashing on our hard-to-borrow screener. This brings us to a crucial concept, cost to borrow, or CTB. Imagine you want to short a stock. To do that, you first need to borrow shares from someone who owns them. The cost to borrow is essentially the annual fee you pay to rent those shares. When this fee gets extremely high, it's a big red flag that something interesting is happening. It means shares are in high demand from short sellers, but the supply of shares available to lend out is very, very low. The higher the CTB, the more expensive and difficult it is to hold a short position because that feeds into any potential profit. Why this stock is hard to borrow right now. For BOXL, the annualized cost to borrow fee is a staggering 952.4%. Display CTB number prominently. That's almost 10 times the value of the shares just to hold a short position for a year. This astronomical fee, combined with an estimated float of just 0.5 million shares, tells us that borrowable shares for BOXL are incredibly scarce. The short interest might not be reported yet, but this CTB number is a clear indicator that short sellers are paying a premium to maintain their bets against BOXL. Squeeze mechanics explained. So, what does this mean in the context of a short squeeze? A short squeeze happens when the price of a heavily shorted stock starts to rise. This rising price puts pressure on short sellers who borrowed shares then sold them, hoping to buy them back cheaper later. If the price goes up instead, they start losing money. With a high cost to borrow like BOXL's, that pressure is intensified because they are bleeding money daily just to stay in the trade. When the pain gets too great, or their brokers demand more collateral, short sellers are forced to buy back shares to cover their positions. This forced buying creates even more demand, driving the price higher, and forcing more short sellers to cover. It's a cascading effect that can lead to explosive price movements, especially in stocks with a small float like BOXL 0.5 million shares. Dilution risk check. Now let's talk about dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically reduces the value of existing shares and can completely negate a short squeeze, even if the cost to borrow is sky high, because new shares can be easily borrowed and sold to short sellers. Good news for BOXL is that our screener found no recent diluted SEC filings like SMIN S1, SMIN S3, or 424B in the last 90 days. This means the company hasn't recently added new shares that could easily be used to offset a squeeze. Recent reverse split watch. Another important factor for BOXL, the company executed a 1-for-6 reverse stock split on June 22nd, which was about 55 days ago. What's a reverse split? It's when a company reduces the number of its outstanding shares, proportionally increasing the share price. For example, if you had 6 shares, now you have 1, but that 1 share is theoretically worth what your 6 shares were worth combined. While often done to boost a stock price above minimum exchange requirements, reverse splits also reduce the float, the number of shares available for trading. We've historically observed that many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market digests the new share structure and reduced float. It's a pattern, not a guarantee, but it's certainly something to keep in mind for BOXL given its recent date. Again, a very important reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should we watch for with BOXL? Our internal composite squeeze score, which combines factors like CTB level, CTB momentum, shrinking borrow supply, float size, volume/price momentum, and technical setup, currently sits at 41.0. While this isn't the highest score we've ever seen, the 952.4% cost to borrow and the tiny 0.5 million share float are certainly attention-grabbing. Remember, a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction and are willing to pay those massive fees because they believe the stock will ultimately go lower. We need to see continued strong volume, positive price momentum, and ideally, further tightening of borrowable shares. We currently have unknown for shares available to borrow, so any new data showing that number shrinking would be a significant development. Keep an eye on the daily volume and how BOXL reacts to price levels. In summary, BOXL Corporation BOXL presents an interesting case study with its incredibly high cost to borrow, small float, and recent reverse split. It's a prime example of a stock showing the characteristics that often precede significant volatility. This is not a recommendation, but a deep dive into the mechanics that can drive explosive moves in the market. As always, education is key. If you found this explanation helpful, please hit that like button, subscribe for more deep dives into hard to borrow stocks, and let us know in the comments if you have any questions or other tickers you'd like us to analyze. Until next time, stay safe out there and happy learning.